Launching an ETF is no easy task, even as ETFs continue to attract major investor attention. As of last week, there were 103 new products launched, and last year there were 271 new ETFs launched. Here today to talk us through a successful ETF launch is Gregory FCA co-owner Joe Anthony, as well as Phil Bach. He's joining us remotely. Phil is the CEO and co-founder of Exponential ETFs. Now, later on this month, both Joe and Phil will be on a panel at the 23rd Annual Global Indexing and ETFs Conference. The topic of that panel discussion there will be making an entrance, ETF launches. Joe, let's start this discussion with you. We've seen some smaller issuers beat bigger players to the punch with some of the ETFs we've been involved in. Do you think it's easier to bring a groundbreaking ETF to market if you're at a smaller firm?
Well, I think Phil might agree, Julie, that I think there's a lot of advantages today to being a smaller upstart issuer. Number one, a big issuer has a lot at stake. And take a look at the Vanguards and State Streets of the world. They are sitting on piles of cash. The momentum's in their favor. Shifting strategy, shifting directions requires a lot of moving parts. At the same time, they are deep-pocketed organizations. So from where I sit, we like to be on the side of firms like Phil's and others out there that are bringing new and novel ideas to market. Take, for example, just a couple names that we've helped take off the last couple years. Phil's firm launched RVRS, Reverse. It's the first reverse cap-weighted product hit the market. There's no way in heck that Vanguard, State Street, and the big players who have rolled the dice for something like that and basically gone against everything they've done. Take a look at what Amplify has done with iBuy. They challenged a category, bringing a brand new product to market in iBuy that basically told XRT, which was the bellwether in the retail space, to go shove it because they thought they could do it better. And they've proven from a performance standpoint and darn near on an asset standpoint that they could be a real player as a small shop. Those are just two examples of many where being smaller is actually better.
And Phil, I see you nodding your head there. Is there anything you want to add to that?
Well, I think Joe's exactly right. You know, coming in as a new upstart, you're not tethered to the old ways of doing business. You don't have legacy assets and legacy products to protect. You know, when we did reverse cap, like Joe alluded to, we weren't saying that market cap weighting is the wrong way to invest. Therefore, our existing funds are the wrong places to invest. We're saying that market cap weighting is in fact the wrong way to invest, but we haven't sold you any market cap weighted funds that we're now telling you are inefficient and are not the best way to invest. So coming in as a new upstart, it really allows you the freedom to challenge conventional wisdom, to disrupt the industry, and to do things differently, to do things from scratch, ground up, the right way, the way that you think things should be done, and implement strategies and ideas and ways of doing business that will that will lead the way going forward and for, hopefully for a long time.
And I think one of the things, Julie, that I want to jump in and share on this too is that I think a smaller player can't afford not to promote their products, and they can't afford not to be different. And if you're trying to bring something to market that has been done before, or if you're going to bring something to market and not backfill it with a real promotional and marketing distribution effort, you're not going to be successful. So that's why I think actually being a smaller player allows you to bring new ideas to market more successfully, because you're forced to do the things that make a product be successful. You can't throw a bunch of stuff against the wall and hope something sticks, because frankly, time and money aren't on your side as a smaller player.
And you both sort of touched on the next question when it comes to approach. Now, Phil, your firm has taken both an academic as well as a scrappy approach to making a name for your firm and your products. What was behind that line of thinking, and what do you think it takes to succeed in bringing new products to market?
Well, at the same time that it is an advantage to be an upstart firm like we just talked about, there also are some disadvantages. We're competing against some of the largest corporations in the entire world, and we're competing against the likes of the top bracket investment banks and the top bracket mutual fund companies. So we have to find ways to multiply our voice and amplify our message in ways that, if we had 6,000 people who are doing sales, or if we had a book of hundreds of thousands of clients already, we might not have to do. But working with firms like Gregory FCA and working with the media is a real opportunity to be able to multiply the messaging that you're saying. I can call a client and tell a story once, or I can call a journalist, and if the story is compelling enough that they find it'll be newsworthy to their audience, I can tell that same story once and have it read by tens of thousands of people and potentially potential clients. So we found that being media heavy and really prioritizing media opportunities has helped our business very much.
So, Phil, one of the things that we take a look at too, and obviously spending time working with you and your team, the idea of you can't be a single channel marketer anymore. And frankly, you can't hire enough salespeople to get the momentum going. You really need to think outside the box. From your perspective, I think on the issuer side, I think it'd be great to talk to our audience a little bit more about what do you see as some of the sneaky tricks that you think are helping you be successful? Where are you making a name for yourself? Would you say it's going beyond? I mean, for example, we know you launched a podcast recently, trying to think different ways and different channels. Has that been helpful for you?
The podcast has been phenomenal. The feedback has been really strong from clients. We've had inbound inquiries from people that have found the podcast. The podcast is available for download on our site, on iTunes, anywhere you get your podcast. It's the Exponential ETF Exceptional Podcast. And we're still early and we're playing around with the format, but we're also blogging and we're also on social and we're also doing, real white papers and media analysis, because there's a whole spectrum of potential clients out there and each one is looking for something different. Some want to be entertained with a podcast where we can, have a good time and keep it light, and somewhat heavy analytics. And we need to be there for everyone. While we can't be there necessarily as much as our competitors in a direct one-to-one sales capacity, we can in terms of content generation. So we've tried to diversify our content book, if you will. We've tried to diversify our content offerings and provide a little something for everyone. And over time, as we start to build out and get better and better at providing content, we'll have better and better analytics, and we'll be able to see, where to really focus our efforts and where people are coming from. But you really do have to scattershot it a little bit and see what comes back, and be nimble. Listen to the feedback from clients. Listen to the feedback of people that are, maybe politely telling you this is great, but it's not necessarily leading to increased interest in the funds, and adjust accordingly.
Got it.
All right, well, your firm just saw your flagship ETF, ACSI, surpass $50 million. What lessons have you learned from that climb to that level of sustainability?
Well, it's certainly a hard climb, and we're certainly not done yet. So it's a good jumping off point, a good starting point. But I would say that the key thing is really starts in the product development process before you launch. You need to find 3 to 5 people who are willing to allocate capital into the strategy. And if you can't sell it before it's launched, that's a hint that maybe the message isn't resonating with the audience as much as it's resonating with you. I have a lot of ideas that I think are brilliant. Until we find 3 to 5 people that we know will allocate money to the strategy, we don't launch it. The other thing I would say is be very nimble in your approach. So, our marketing messaging and the way that we present our funds has changed very much and evolved over time. And it's going to continue to evolve as we try different messaging and we see what works and resonates and what doesn't. We try to be as nimble as possible and not necessarily adjust and tell people what we think they want to hear. Create messaging that we think is really gonna resonate and is going to make a difference and do things differently, but to be flexible in that approach and nimble in that approach, where we can always reserve the right to get smarter and adjust and adapt.
And the last question is for both of you guys. How should 2018 shape up compared to 2017 in terms of ETF launches?
I think from my standpoint, we're seeing continuation of thematic products being brought to market. We're really excited. One of our friends in the business is about to bring the first space ETF. I think it's really exciting. Maybe he's a little early, who knows, we'll see. But I'd rather be early and first than late and last. And you take a look at the bigger picture, beyond thematic, we're seeing more and more pushes towards innovative ideas in the actively managed space. Only 2 of the products launched over the last year, since this time last year, that have made the top 10 in terms of asset gathered have been actively managed products. I think we'll see a little shift in that. More actively managed products will gain some steam as we move ahead the rest of this year and beyond. But beyond that, I'm curious to see what Phil has to say.
Yeah, I agree with that. I think more and more advisors are realizing that they need to differentiate their client portfolios while they compete with robo-advisors and they compete with very, very cheap and sometimes free financial advice that's usually very vanilla. So they need to start customizing portfolios that can provide more alpha and that can provide products that are going to speak more to their clients' hearts, to their clients' specific preferences in terms of what they invest in. And we're going to see more and more products come in to match that interest. I think the domination of asset flows that we've seen into market cap weighted vanilla index funds is not necessarily going to come to an end, but we're going to start to see that market share erode as we come out of this momentum cycle, which has been very favorable to market cap weighted index funds.
And that is all the time we have for right now. Joe Anthony and Phil Bach, thank you for being here. For more insights from Gregory FCA, you can visit financialservicesmarketing.com.